The growth style of investing is quite popular in a growing economy like India, barring the disruption caused by the pandemic, of course. But basically, the investors who invest in this growth style are chasing a kind of momentum of growth. So they're looking for companies which are growing above average, and they're looking for companies which are growing consistently. The main characteristic of growth stocks is that they exhibit relatively higher earnings growth, both historical as well as on forward projections. These stocks show higher growth in terms of sales and cash flow. But the most important metric is the consistency of this growth. These stocks generally have higher price to earnings and price to book than peers, and a lower dividend yield because the profits are being plowed back into the business. Typical examples of growth stocks could be HDFC Bank, HUL, Kotak Mahindra Bank, Bajaj Finance, and Asian Paints. Growth stocks tend to outperform in an environment of falling interest rates and when corporate earnings are rising, but they can get badly hit in a slowdown. And investors also need to be wary of new and disruptive technologies which are emerging, which could throw the future plans of such companies out of gear. There are a few other risks to consider. Growth is an overcrowded trade. There are too many investors chasing this pack, and which is why you also tend to end up overpaying for growth. Of course, the business itself will command a premium too. Then there is the very real possibility that the company cannot meet the future projections of growth for which you have paid already. The easiest way to know if your fund follows this style of investing is to check the style box. Some common examples of funds which follow this style are the Axis BLUECHIP Fund, Axis Focus 25, UTI Equity Fund, and the SBI Focused Equity Fund. So there is no conclusive evidence to suggest that either value or growth have outdone each other. Over the longer time frames, if you look at it, the trends seem to even each other out, But it's within the business cycles that you can actually catch the difference, because it is said that, value seems to do well in a bear phase and growth seems to do well in a bull phase, right? So it's always best to have a judicious mix of both in your portfolio.